Welcome and thank you for standing by. At this time, all participants are on a listen-only mode. Today's webinar is being recorded. If you have any objections, you may disconnect at this time. Now, I'd like to turn the call over to your host, Claire. Claire, you may begin.
Thank you so much, Tony. Hello and welcome, everyone. My name is Claire Eamon. I am the Acting Associate Administrator for the SBA's Office of International Trade. And I want to welcome you to our 2023 Midpoint Economic Outlook event. I would like to start off just by thanking our special guests. We have Lynn Galkowski from ITFA and Ruben Nazard, who is our featured speaker. And I also especially want to thank all of you for taking time out of your busy day to join us online. We had well over 500 people registered for the event. Our audience here is current and prospective lenders who already work with the SBA, export-related service providers and counselors, and then most importantly, we have the small business exporters themselves. We're really especially glad to welcome you to this session. Before I just start with some opening remarks, I did want to do a little bit of housekeeping. If as you're listening to the presentation, you're thinking of questions that you might want to ask, I ask you to please put your questions into the Q&A function in the WebEx app. We are going to have a Q&A session following Ruben's remarks. That will be led by SBA's Director of Trade Finance, Dan Pichet. So please, if you are thinking of any questions, just use that Q&A function, not the chat, but the Q&A function in the app. And then as a final housekeeping note, I did want to mention that this event is closed to the press. So thank you for that. So now let's get started with our program. So as I said, I work in the SBA's Office of International Trade. And of course, it's really core to SBA's mission to improve access to capital for America's small businesses. Here in our Office of International Trade, we really focus on exporting and helping transition small businesses into global markets. Exporting used to be focused mostly on manufacturing, and that's still an extremely important export sector. But with the rise of e-commerce and digital services, more and more businesses are trading internationally. If you look at 2020 census data, the latest data that we have shows out of the 33 million small businesses, about 264,000, so less than 1%, are exporting goods. That's, of course, still a very significant number, but we know it doesn't capture the exploding number of businesses that are exporting services or doing e-commerce. It also doesn't capture small transactions under $2,500. So the Office of International Trade at the SBA did some of its own research that we published earlier this year called the Total Addressable Market Study. This study looked not only at that census data, but it also looked at surveys of small businesses to be able to capture some of those businesses that are providing digital services and e-commerce. And we actually found that the actual number of small business exporters is around 1.3 million businesses, with an export volume of about $1.1 trillion a year, which is really significant. And then if you look at tradable sectors, so sectors where there's a good or service that could potentially be exported, our research found that the potential market size, or the total addressable market, is really over 2.6 million small businesses that could be exporting. That is 42% of all small employer businesses. So it's really a much bigger pool of businesses that could be exporting. And now the one thing that they do have in common is they all need access to capital. Small business exporters in particular tell us that financing is really one of their biggest challenges. And over here in the Office of International Trade, we call this the trade finance gap. Interestingly, we did do another study this spring to dive more into the trade finance gap and look at export revenue as a percentage of total revenue of business. We found that in addition to current SBA export loan users, who are the exporters that are currently using an SBA export loan product, there's several emerging segments of exporters that could benefit from some of the SBA support, but they don't currently require trade-specific loans. After all, most American exporters are actually deriving only part of their revenues from exports. The study found that exports are really sort of less than 10% of all small employer business exporters' total revenue. What does this mean? It means that the SBA, we can leverage also our domestic mandate to help more businesses operate in international markets. So for us, really understanding most small business exporters are also doing domestic selling. The SBA we're really leaning into our entire suite of loan programs to help support those businesses' international expansion as another means of closing the trade finance gap. So you're going to learn a lot today just about the general economic outlook. We also are really proud to be partnering with organizations like ITFA as we're all working together to help promote exporting and close the trade finance gap. I'm really happy to announce in June, the SBA and ITFA signed a partnership with the goal of providing educational webinars like this one today. So we're really happy to be doing it. And with that, I would like to transition over to Lynn Galkowski from ITFA. Just a little bit about ITFA. It's an organization that's helping to address the trade finance gap and support businesses that are involved in international trade. I'd like to turn it over now to Lynn for a presentation just about ITFA, some insights, and to outline some of her priorities, or ITFA's priorities, for 2023 and 2024. So thank you so much for your attention. We're so happy you're here, and I'll turn it over to Lynn.
Thank you, Claire. Much appreciated. Good day, everyone. I'm so pleased to be here on behalf of ITFA's Board of Directors and ITFA America's Advisory Board to share with you who we are and what we do to support global trade. ITFA Americas and ITFA Global, the International Trade and Forfeiting Association, is a worldwide trade association for companies, financial institutions, and intermediaries engaged in global trade finance. We were founded in 1999, and there are 300 members worldwide in 50 different countries. ITFA brings together banks and financial institutions who are fully engaged in originating and distributing trade-related risk and finding creative ways to risk mitigate. We can move on to our mission statement on the next slide, if you'd be so kind. Thank you. ITFA basically represents the rights and interests of banks, financial institutions, and service providers involved in trade risk, asset origination, and distribution. So mainly, and most importantly, we provide very ample networking opportunities around the globe, whether you're in New York, London, Toronto, Mexico, Miami, Abu Dhabi, Spain, Singapore. You can find a group of us and a group of members that will be facilitating networking opportunities, whether that's a meet and greet, whether that's an educational opportunity, a conference, panel discussions. We're here to do incredible networking opportunities across the globe because trade is in fact global. We provide educational sessions, much like today that Claire mentioned, as well as panel discussions and white papers that are super important for the global trade industry. We also contribute to creating a safe and transparent trade finance industry. We're all about transparency, and we cooperate with many partner associations across the trade finance spectrum to promote the interests of the membership, whether that be with regulators or legislators or other bodies that are important. We're at the forefront of understanding the current and emerging changes in trade finance, and we aim to improve governance and best practices and help shape the rules. We as an industry association also attract new skills and younger talent to the trade finance world and industry, all in an effort to expand global trade. We can move to the next slide, please. That would be great. And to give a bit of a snapshot into what our membership looks like, this is just a pie chart that shows, as I mentioned, 300 members, whether they be financial institutions, insurers, brokers, legal, 50 countries. You can see a breakdown of some of the countries here. You'll notice that the Americas right there is a very heavy section for us. We're growing very rapidly throughout this footprint. And the UK, London is definitely an epicenter, but we are a global organization, thus APAC, continental Europe, Middle East, Africa, Americas, and UK, the Isles are all represented there. If we could kindly go to the next slide. Thank you. We're broken down as an organization. Certainly we're global, but we have committees and functions. So the first line item there, regional committees. Essentially, we have a global board, which I sit on, and then we have regional areas. So on the left, you'll see AMRC, which means America's Regional Chapter. That entire block should be in black because we're the Americas. We're just not US and Canada. So that is our group on the Americas here, and that's the Strategic Alliance Memorandum that Claire mentioned. We're partnering with SBA and US International Department of Trade to really help buoy and leverage global trade and be a resource to everyone here on this call to the extent that it is helpful. Another major committee we have is our Education Committee. Sessions such as these, whiteboard sessions, trainings, We typically, when we have conferences globally and certain panel discussions, we will have adjacent to that, we will have a different specific format for an education for maybe an emerging leader or a young professional, or for a specific subset like small business administration or small business lenders. We really do aim to tailor our education and buoy the depth of knowledge that we have in our membership and share it with the rest of the global trade finance industry. We also have a market practice committee that is based out of London, but that is an exceptional committee in that there are many white papers that are issued. We go in front of legislatures. We just did so in the UK to try and change legislation relative to trade finance based on our interests, whether that be relative to an interpretation of a Basel IV requirement relative to capital weighting. There are many ways the Market Practice Committee helps global trade, and there are white papers that are on our website, www.itfa.org, that gives substantial information from an industry perspective relative to the initiatives that we do have. Our FinTech committee is broad, as you can well imagine. There are many fintechs in the trade finance world now relative to digitization and trying to take a very paper-based industry and transforming it into a new future state. So the FinTech committee is incredibly active with all the new vendors and platforms and interoperability entities that are helping us to transform the way we do business from a financing perspective for trade finance and all the documentation that is related to trade finance. Our insurance committee is actually enormous, and it's very, very impactful. In fact, we have, it's run out of London, but we have an Americas Insurance Committee as well. And essentially, risk mitigation is one of the main tools to improve a portfolio. In your trade finance book, for example, I'm a portfolio manager. So we use this channel of risk mitigation in the banking world, which I am in, to help improve the balance sheet and also reduce capital requirements. So this insurance committee is front-facing with regulators in the UK and in the US. And in fact, stay tuned. We have some interesting developments on the US side that may really help a lot of the financial institutions get better capital relief relative to Basel IV. One of the committees close to my heart, ESG, Environmental, Social, and Governance Committee. That is a very strong committee. We're very focused on sustainability as well as social goals. And we have many of the financial institutions as well as commodity companies that are involved in formulating and shaping this initiative that we have throughout the globe. Our emerging leaders, we obviously need to create wonderful talent in this industry that we have. So we have a dedicated emerging leaders group, and with some stewardship from the old timers like myself, to help bring young talent and professionals into this exciting world of global trade. Institutional relations, we have an ITFA multilateral advisory panel, which I'm on as well. And essentially it is the large multilateral agencies in the globe. Some of them will be the World Bank, for example, International Finance Corporation, European Bank for Reconstruction and Development. There are many of them, and one in the Americas as well, which is the Inter-American Development Bank for Latin America. And this advisory panel takes the heads of all these agencies to collaborate to see how they could be partnering with ITFA to help spread the word of the exciting risk mitigation tools that they have, all in an effort to shrink the trade finance gap and certainly expand global trade. The next slide, please, would be great. Thank you. Okay, great. So now I'm going to, with that, I'd like to turn the presentation over to Ruben Nizard, our featured speaker and distinguished ITFA member, who is also head of political and social risk analysis at COFAS, to share his insights on the 2023 economic outlook, which is why we are all here today. Thank you. Ruben, over to you.
Thank you, Lynn. And thank you to the SBA and ITFA for putting this session together. Thank you for joining us today. I'm really happy to have this platform to share the outlook. My name is Ruben Nizard. I'm COFAS economist for North America and head of political and social risk analysis. Just a quick word, COFAS is a trade credit insurer, one of the world's leading trade credit insurer, and one member of ITFA. So this affect, of course, my perspective on the economic outlook, and we keep a very close eye on business developments and on trade developments. So for today, I would like to share my outlook for the U.S. economy in particular, but I'll start also with a few considerations on the global outlook, including the dynamics in global trade and supply chains. So let's start, and I like to start with GDP growth forecast at the global level, just to give a broad overview of what are the key trends in the economy. And what you can see here with these two slides is that after a strong post-pandemic recovery in 21 and 22, the global economy is set to slow in 2022, in 2023 and 2024. This slowdown is mainly being driven by a slowdown in advanced economies, as several factors are weighing on economic activity. We are seeing the post-pandemic rebound and surge in demand fade. We are seeing in this context, and we have seen a surge in inflation that has put some pressure on consumers' disposable income and has weighed on their ability to spend. We have seen in response to this inflation, strong monetary policy response that have tightened credit and financial conditions across the board that are weighing not only on consumption, but also on business investment. So these are some of the factors playing into the slowdown in advanced economy. In addition, we are also seeing some of the spillover impact of the invasion of Ukraine by Russia last year, particularly in Europe, where the energy crisis and the shock on prices of energy in Europe has played a major role in the slowdown of the European manufacturing sector over the past 9 months. So these are some of the factors that are still shaping the global economy, and that will continue to play a role in the outlook. Another key aspect when we look at these global GDP growth forecast and what we can see from this is that most of the growth will come from emerging economies. And this will be due to a combination of factors. First of all, we will see, and we continue to see, some resilience in commodity exporting countries as we are seeing commodity prices remain higher than they were before the pandemic. Another factor that is playing into this higher contribution from emerging economies is that China is rebounding after being slowed and constrained by COVID-19 restrictions, and is helping some emerging economies, thanks to boosting demand from China, to recover. But while the Chinese economy is set to recover, and as we'll see, there are also some challenges in China. And what you can see on the right-hand side chart with our forecast for China is that growth is expected to be below 5% in both 23 and 24, which would, for China, be a disappointing outturn in terms of economic growth after growth has averaged nearly 10% over the past 3 decades before the pandemic. So these are some of the factors that are shaping the global outlook. But there are also other things that I wanted to mention considering global considerations. And first of all, I wanted to mention dynamics in terms of global trade. We're doing this with ITFA and SBA. Probably a lot of attendants today are interested in exports and trade dynamics. And a lot has been happening over the past 3 years to global trade and global supply chains. Amid the COVID-19 pandemic recovery, we've seen severe stress on supply chains as a surge in demand for goods and manufactured goods, at the same time as the production capabilities and capacity of the global economy were strained by COVID-19 lockdowns, has created these tensions. But what we've seen since the middle of 2022 is that these tensions on global supply chains have eased, and this indicator of supply chain pressures on the left-hand side chart even indicate that supply chain pressures have returned to normal. But much of this return to normal has to do with the slowdown that we are currently experiencing in the global economy, and more specifically, a slowdown in global trade. As I've already mentioned, we are seeing a slowdown in consumption for goods, particularly in advanced economies. This is particularly the case in Europe, but we're also seeing some signs of slower consumption of goods in Europe, in the US, and in China, the rebound is disappointing in terms of consumption. So all this is playing into slower trade dynamics, as you can see on the right-hand side chart, and in turn, this is feeding into lower supply chain pressures. So while the improvement in supply chain pressures is good news for the global economy, it comes, you'll see, with a big caveat, which is a slowdown in global trade. Third global consideration that I wanted to mention was commodities prices, because we've also seen a lot of movements in the past 3 years in terms of commodities prices. After reaching lows during the pandemic as consumption plummeted, we've seen a very rapid recovery in prices that have been exacerbated by the war in Ukraine, as Russia and Ukraine plays important role as exporters of commodities, agricultural commodities, of course, in Ukraine, but also energy commodities, some metals, including some platinum metals that play an important role in energy transition. So, of course, this has affected prices, and prices have reached multi-decade high at the beginning of 2022 and in the summer of 2022. But since then, you can see that there has been quite a sharp correction in terms of commodities prices. And this is because, again, we are seeing signs of slowdown that are weighing on demand for commodities and hence on prices. So this is why we've seen these prices decline. But what I want to highlight here is that while prices have declined, first of all, they remain higher than they were before the pandemic for most of them. And second of all, when we look at the picture on the supply side of the equation on a whole range of commodity categories, the risks are to the upside for prices. If you look at energy prices, they are likely to be durably impacted by the impact of sanctions on Russia, one of the leading oil and gas producers, but also some continued constraint on output in OPEC countries. When we look at metals prices, the competition for access to critical minerals to achieve energy transition is likely to maintain prices higher. And we are seeing also some stress on agricultural commodity prices, and we've seen that in recent weeks with notably a grain deal between Russia and Ukraine that has collapsed, and that is imperiling some important trade flows of commodities and grains that is likely to push prices upwards. We are seeing some protectionist measures, and we've seen just a couple of weeks ago India implementing some export ban on rices, which is also impacting prices. So overall, while prices are a bit lower than their peak from last year, we have to understand that prices are likely to remain higher than they were, and there is a new normal for commodity prices. And this is also so important to keep this in mind, not only for the activity outlook, but also for the inflation outlook. Before I move on to the US economic outlook, I wanted to just say a quick word on China. Of course, China is an important economy, and it has been the main driver of global economic growth over the past decade. After the great financial crisis, it accounts for nearly half of global economic activity. So this is, of course, very important, and we've all been following very closely at the reopening of the economy after activity was constrained by COVID-19 lockdowns that have dragged on for years and through the end of 2022. And what we are seeing right now is quite a disappointing rebound. And there are several factors that are explaining this disappointing rebound in China. First of all, we are still seeing some difficulties in the property and housing market in China, which is weighing on overall economic activity. And without meaningful government support, it does look like the housing and construction sector in China is slowing and contributing to lower economic activity. We are also seeing this trickle into lower economic activity for industrial production, as a lot of the demand from the Chinese construction sector is driving industrial output. But we are also seeing that export dynamics, and notably because economic growth in Europe, because economic growth in the US, especially consumption on goods, is slowing, we are seeing industrial production being quite weak and the rebound in industrial production being quite weak. Third factor in this disappointing rebound of industrial production is that after a pop in demand following the reopening of the economy, we are seeing the Chinese consumer being quite cautious in terms of spending. And we are seeing some factors playing into slower demand dynamics, and the shift to consumption is proving a bit more difficult to achieve for the Chinese economy. We're notably seeing very high youth unemployment, which is weighing on consumption and then on industrial production. So these factors are very important to understand as they shape the global economic outlook. But what about the US? And when we look at the US economy over the past 18 months, we have to draw a conclusion of a resilient economy. In spite of growing headwinds, namely inflation reaching a 4-decade high in June of 2022, and the Federal Reserve conducting one of the most aggressive interest rate tightening cycle, we are seeing the economy continue to grow at a fairly robust pace. And this is displayed and showed by these two graphs presented here. So on the left-hand side, you can see a set of indicators that are followed by the National Bureau of Economic Research to actually determine if the US economy is in recession or not. And you can see that if some of them have indeed slowed and have even plateaued in recent months, I'm thinking more specifically here about industrial production, as demand for goods has slowed, and in terms of manufacturing and trade sales, as business spending has also slowed, we are still seeing some growth, and especially growth being supported by consumption. And this is notably thanks to a strong labor market that continue to defy odds of a sharper slowdown. I also like to put this recovery in the US in perspective, and this is what you can see with the right-hand side chart. You can see that when we look at the GDP levels at the end of the second quarter of 2023, the United States has recovered more strongly than most of its and than all of its G7 peers. And this is quite a notable achievement. As I mentioned, Europe has had some more challenges associated with the war in Ukraine that are probably weighing on this, but still the strength of the recovery that was again displayed in the GDP figures that were released late last week are a cause for celebration and a sign of resilience that could continue. And I have to say that in recent months, we've seen a lot of economists forecasting a recession, but so far the US economy has defied those odds. And one key factor that have helped the US economy avoid a recession is the health of the consumer. And we've seen that despite some shifts in consumption in the US, the US consumer has continued to spend. That's what you can see on the left-hand side chart. And we've seen initially in the post-pandemic recovery, a lot of spending on goods as access to in-person services were still constrained by pandemic restrictions. But since the beginning of 2022 and the full reopening of the economy, we're seeing stronger growth in services that continue to support some activity and spending at the U.S. economy for the U.S. economy. And this strength in spending has several causes. One of them, you can see it displayed here on the right-hand side chart. Households in the US have emerged from the pandemics with healthy balance sheets. During the pandemic and during the lockdown, they have been able to build a cushion of excess savings compared to pre-pandemic trends and a cushion of cash that they are now spending and to cushion the impact of higher inflation and higher borrowing costs for those who have been impacted by higher borrowing costs. I have to say also that part of this recovery and this willingness to draw into these excess savings for US households has to do with the strength in the labor market. And it is just, it has been again demonstrated by some job numbers that were published this morning. But we have an unemployment rate still near a 50-year low and still healthy job growth at the US economy. And this is supporting in turn income and then spending. So this has been one big factor into the resilience of the US economy. And that can continue to last as we see some moderate signs of cooling in the labor market. And there are still some savings left and excess savings left for US consumers to dip into. Another important factor that I'd like to mention in terms of the resilience of the US economy has to do with business spending and business investment. As we've seen interest rates increase in the past 16 months, of course, the cost of capital has increased and it has become more difficult for businesses to find funding and to spend. And we are seeing some signs that business spending is indeed slowing. But when we look at it a bit deeper into the data, there are some surprising numbers, and these have to do with notably the health of spending on manufacturing structures. And this is demonstrated by these two charts. We are seeing a very sharp increase in spending on manufacturing facilities in the US. And these very sharp increase with the volume of spending nearly doubling since 2021, it can be attributed to some of the policy initiatives of the past few months. And namely, we are seeing and we are starting to see some impact of the CHIPS Act. And this is demonstrated by the fact that most of this spending on manufacturing facilities is for manufacturing facilities in the electrical and electronical component. So it does look like the subsidies, including in the CHIPS Act, is indeed attracting more investment and is helping to, and is giving a bit of a boost to business spending at a time when it's a bit more difficult. So overall, we have a picture of economic resilience. But while we have this picture of economic resilience, when I look at the way forward and when I look at the outlook, I still see a lot of challenges. And the first of these challenges, of course, is still inflation. The good news is that inflation has peaked since it reached a 4-decade high of 9.1% in June of 2022. It has been divided, the annual headline inflation rate has been divided by 3, being at just 3% in June of 2023. So some good news. This decline in inflation has been driven by slower and by a decline in energy prices as the impacts of the war in Ukraine on global energy prices faded. But it has also a lot to do with a decline in the contribution of goods inflation, as we've seen supply chain heals a little bit after the stress of the pandemic. So this is the good news and the good part, and the good part of the story. Now, the more concerning aspect is that when we look at inflation numbers a bit more into detail, we are still seeing some signs of sticky and more entrenched inflation that could keep it above the 2% target of the Federal Reserve. You can see with the right-hand side chart that if monthly growth in prices does not slow meaningfully in the coming months, we would see the annual headline inflation rates and the progress in the annual headline inflation rate be much slower than what it has been in the past 12 months. So this is an important note of caution, and especially as we've seen some signs of inflation in services that is still a bit higher than it was before the pandemic, and some positive signs that were in the latest CPI and PCE inflation reports will have to be confirmed before we have the conviction that inflation can meaningfully and sustainably return to the 2% target in the United States. And this is because of these concerns that the Federal Reserve has remained aggressive and has been very aggressive over the past 16 months. This aggressiveness in here is put in the context of both an international tightening and of an historical perspective. On the left-hand side chart, you can see that the US Federal Reserve is leading the tightening cycle and has been the most aggressive central bank in terms of the cumulative rate hikes since the beginning of this tightening cycle in the beginning of 2022. On the right-hand side chart, you can see that in recent history, the tightening cycle that is being conducted by the Federal Reserve is the most aggressive since at least the 1980s during the so-called Volcker shock. So we already had a very aggressive rate hiking campaign, and what I'm looking at now is the outlook, and evidence are that the Federal Reserve will remain aggressive in the sense that at least it will keep a restrictive stance in the month ahead, a stance that will continue to weigh on economic activity and probably a bit more meaningfully than what it has so far. So these two charts, they present the projections of the Federal Reserve and also what market participants and what markets are pricing in terms of rate hikes and rate cuts. And in very short, what these two charts show is that the monetary policy stance in the United States is likely to stay very restrictive and to stay much more restrictive than what it has been in the past 20 years at least, for at least another 6 months. And that it would be very, very surprising to see the Federal Reserve cut rates before the end of the first quarter of 2024. There is a bit of a difference in terms of forecast between what the Federal Reserve presented after its June meeting and what market participants are currently pricing. I have to admit that I'm a bit leaning towards, and I'm a bit closer to, my forecast is closer to what market participants are thinking. I believe that the rate hike that the Fed did last week was probably the last one for this year, and that a rate cut is unlikely before Q1 2024. So this is important to note. We have a Federal Reserve that is past its hawkishness, and that is probably going to prove less aggressive than what it has been in the past 16 months, but it will remain restrictive at the time when we are likely to see more of the impact of the cumulative tightening that the Federal Reserve has done so far. Because what is important to mention when we talk about monetary policy is, this is mentioned by all economists, is that monetary policy works with long and variable lags. And when we look at the monetary tightening of the past 16 months, it's only been 16 months that the Federal Reserve started raising interest rates. And we are starting to see some more signs of strains on credit availability and on financial conditions. Here you have two charts that are showing that we are starting to see the impact of this Federal Reserve tightening. When we look at the survey of lenders that is conducted by the Fed, we can see that more and more lenders are reporting tighter credit conditions, particularly when it comes to new loans for businesses. You can see with this left-hand side chart that the level of tightening implemented by lenders is at par with times of recessions and times of crisis. So this is not something that we should take lightly, and this highlights, in my opinion, why more challenges are ahead and why the US economy is set to slow in the month ahead. And we are starting to see that in the actual numbers and in the actual figures of lending flows. That's what you can see on the right-hand side chart, where we're seeing quite clearly that lending flows are slowing and are even slightly contracting on a weekly basis. And this is particularly the case, again, for business loans, which bodes ill for business spending prospects in the months ahead. So with that being said, it does look like these tighter credit conditions, these tighter financial conditions are going to impact economic activity. They're going to slow the economy, but it will slow the economy from a fairly robust base, in my opinion. So this is why I continue to believe that the US economy in this cycle is still well positioned to narrowly avoid a recession in 23 and 24. But risks are still high, and this is something that we need to keep in mind. And another example and another illustration of this higher risk premium is that we can see is when we look at the evolution of business bankruptcies. After a period of very low business insolvencies and business bankruptcies amid the COVID-19 recovery, we are now seeing them picking up and picking up more meaningfully since the beginning of 2023. An uptrend that is likely to continue, and we are likely to see a normalization in terms of pace of bankruptcies. And considering the strain on liquidity conditions and the stricter credit stance and credit conditions, we are likely to even see insolvencies rise above the pre-pandemic levels of insolvencies, in my opinion. So this is definitely something to keep in mind. So I'll wrap things up here. This slide summarizes some of the key points that I've mentioned today. But in one sentence, what I want to highlight today is that we have seen in recent weeks positive news for the US economy, and these positive news should be celebrated and should be taken as a sign of robustness and resilience, as they're quite consistently pointing in that direction. But at the same time, we also have to acknowledge that most of the challenges for the US economy are still probably ahead of us, and that will probably mean for us at COFAS and in trade finance a more challenging month ahead in terms of activity. So with that, I'll leave it here, and I think we'll move on to the Q&A session, which will be led by Dan. Dan, the floor is yours.
Thanks, Ruben. I thought it was really insightful, and obviously we got a chance to speak when we were both in Miami at ITFA's annual conference. You know, starting off in the vein of credit and tightening credit, you know, I'm just kind of curious what your thoughts are about guarantee and risk mitigation programs. I mean, both the SBA and Ex-Im Bank domestically, those offered by export credit agencies globally. What's your take on the role of those sort of risk mitigation and capital relief guarantees in a tighter economic environment, or a tighter credit environment?
So probably need to talk to someone who's a professional in that regard. But my opinion on this is that they do provide a cushion in more difficult economic times, and that they provide some support, and there are very talented people that are able to find solutions to actually support business activity, including in times of tightening credit and more challenging economic environment.
Thanks, Ruben. You know, you mentioned the CHIPS Act and really some of the impacts on supply chain coming out of COVID. What are your thoughts on nearshoring and effectively movements in the supply chain as a whole? I think inflation is down, We've seen shipping costs return to historical levels, but what do you see in terms of the reshuffling of the global supply chain, maybe moving more to North America, to the United States? What are your thoughts on the global supply chain?
Well, it does look that the aftermath of the pandemic is opening a new chapter for global supply chains. So this is the impact of the pandemic that I talked about, but it's also, we have to put that into a broader context. Before the pandemic, we've seen rising tensions, particularly US-China tensions in the space of trade, that have started to alter a little bit the way supply chains are designed. We've notably seen some trade diversion and some trade routes changing, with Vietnam, for example, being one of the winners of these new trade routes, as businesses were trying to protect themselves from potential tariffs targeting their sectors. And in the current environment, we are also seeing rising geopolitical tensions. Of course, the war is back in Europe with the war in Ukraine, but we are also seeing rising rivalry between the US and China, specifically in the tech space. And this is triggering some actions, and this is reshaping and redesigning supply chains. So here I show the impact of the policy measures that are subsidies. It's trying to repatriate some of the production at home. But this is one part of the response to this increased tech rivalry and this increased tensions environment. We are also seeing some export bans being implemented, with quite a drastic export ban that has been implemented on semiconductors and semiconductor manufacturing equipment since October. And this is redesigning supply chains. At the same time, we are seeing increased competition between global leaders and leading countries to access some of the supply to achieve energy transition. We are in an environment, as I mentioned, of tighter supply for some commodities. And at the same time, we have challenges associated with the energy transition that require more of them. So this is also creating some new trade patterns, some new trade shifts. And what we've seen in the Inflation Reduction Act and in the CHIPS Act is that part of the answer is nearshoring. So repatriating some of this production closer to home, so either directly in the United States, but also with partnerships with Canada and Mexico, as many of the subsidies that are included in the Inflation Reduction Act apply to North American supply chain. Now, because there are also some interests that are aligned with other countries and other partners, there is also this discussion around friendshoring. And we've seen in the implementation note of the Inflation Reduction Act that the US administration was trying also to open some of these subsidies to production processes that were partially in Europe. So we have these entire pictures of geopolitical tension that is indeed reshaping supply chains. But what I want to highlight and what I want to conclude on is that while we are seeing a reshuffling in supply chains, it doesn't mean deglobalization. It means slower globalization, probably. It means a different kind of globalization, as we will see new alliances emerge, and the reliance on China is likely to decline very slowly, but this is a trend that we're seeing in some industries, and particularly in strategic industries. But this doesn't mean deglobalization, as I read sometimes in the news, in my opinion.
Looking at the Q&A that came in from the audience, I think there were several comments regarding the CHIPS Act. Just curious if you could say a little bit more about the positive benefits. There were a couple questions about how it impacts small businesses. I think as supply chains reorganize, I think that'll create opportunities for nimble companies to come in. But I'm curious your thoughts on kind of the impact of the CHIPS Act, domestic or in North America, if you will, and how that might help some businesses.
So for the CHIPS Act, I think right now it's only been approved in August of 2022. So it's still very early to fully assess the impact of this policy initiative. But some of the numbers that we're seeing are very clear, and the spending on construction of manufacturing facilities, and notably of semiconductor manufacturing facilities, are quite telling and are suggesting that we are seeing a push and that these subsidies are proving efficient in attracting some more investment. This is a bit of a surprise because the common view on subsidies is that they produce suboptimal results. But this is definitely a positive that we are seeing right now for the US economy. Now, with that being said, when we talk about the CHIPS Act, we're talking about semiconductors. And semiconductors are very complex supply chains because they require a very important level of knowledge and a very high level of R&D. So while repatriating some production home and while investing will provide some results, it will take some time before the US can claim and can ambition to actually claim the role of leading semiconductor manufacturer. And it will probably this will also probably be very difficult because there will be very fierce competition. Europe has passed its own version of the CHIPS Act and is also pushing to try to become more independent when it comes to semiconductor supply. We're seeing it in China also a push to try to secure supply of high-end semiconductors and tech equipment. So all this will leave us in a higher competition environment where some businesses might sometime be caught in the middle. So this is the note of caution that I would have, is that a subsidy wars would be and would produce suboptimal results for all businesses, in my opinion. So some positive for now, and especially when we look at some of these numbers and some of the numbers that I've shared today in the US. But subsidy wars in the long run will probably prove damaging for businesses.
Yeah, it seems like opportunities present, then it's not static, right? It's going to continue to move, as different subsidies roll out and different initiatives launch. So, with that, Ruben, I just really want to thank you for taking time to be here to join us, providing some insights into the economy as we cross the midway point in 2023. So, thank you very much. Thank you for your time. And those on the line, I just want to, as we wrap up here today, I just wanted to let everybody know that the team here at the SBA's Office of International Trade is available to assist. Lynn and Claire mentioned at the top of the presentation, we formed partnerships with IDFA and other organizations to help bring together economic, educational, credit, and all things international for our audiences, which are small businesses either exporting or preparing to export, the lenders who serve them, and the facilitators, educators, and advisors. So please keep an eye on our LinkedIn, keep an eye on connect with the Office of International Trade on there. We'll be announcing all of our events. We have a pretty robust schedule coming together in the new fiscal year beginning in the fall, so more to come. We hope to see you on the next one. Thank you.
This concludes today's session. You may disconnect at this time. Have a good afternoon.